group of traders in 1792 met under a buttonwood tree, kind of casually, to create what would become the New York Stock Exchange.
It's hard to believe, isn't it, that the mighty New York Stock Exchange was once a bunch of guys under a tree. But that Buttonwood Agreement that they reached was hugely important because it was an attempt to formalize a process that up until that point was pretty wild and unregulated. Most of what was happening was trade finance. This is essentially paying for goods that are going back and forth across the Atlantic with bills of exchange, with bits of paper saying IOU. It's not so much the flotation of companies in those early days as trade finance that occupies Wall Street. And the merchants really operated in a pretty informal way, in coffee houses or literally out in the street under a tree. So the Buttonwood Agreement was about creating some rules. And it was necessary because they discovered, as we have discovered in our time, that unregulated markets are prone to big crises. And there had been a big financial crisis in 1792. That was what the agreement was really designed to address. The hope was that the market would be less prone to extreme volatility. So think of it as the first iteration, the first version of what we saw happen in 2008 when Lehman Brothers went bust. It's kind of a familiar story in other ways too. A big national debt. The United States had won its war of independence, but in the wake of its victory, it had all kinds of financial problems to grapple with. A big debt, high inflation, as well as rogue traders in downtown Manhattan. It's the beginning of New York's long struggle to strike a balance between free market forces and regulation.